Guys, what's up? So in today's video we are doing effects of transactions on accounting equation. This is another video regarding accounting equation. I have done one more video. It has all the basics. You should check it. It even has derivations, and we have done a very simple exercise regarding accounting equation. In this video, we are given some transactions and we have to see what is the impact of those transactions on accounting equation. Alright guys, so let's get started. You might have a question, why are we doing this? Well, this exercise allows us to learn impact of each transaction on accounting equation, as well as it gives us a raw picture of balance sheet. The whole balance sheet is based on this accounting equation, which is assets is equal to capital plus liabilities. So throughout this exercise, we are actually looking at this exact equation and we will see what happens and how we balance both the sides. This is exactly what we do on balance sheet as well. So once you have learned all this, it's very likely that you can learn that very easily. And your accounting is going to have a balance sheet topic in future. So this is like basics. You are building a basic ground for your building, which is balance sheet, even income statement. This will help you a lot. Trust me. So be focused on it. I will start with the transactions. However, I do want to tell you guys that there are more questions given in the description box. There will be a link. It will be paid, but it is totally worth it. It has 8 exercises and most of them are like this one. There are some other exercises which makes you actually think. It has a mixture of exercises for accounting equation. So do consider getting it if you want to practice more. Now let's start with today's exercise. Transaction 1. Starting the business. So ABC invests $3,000 of his money in his startup. What's happening? ABC is an individual who is investing $60,000 of his money, his own personal savings. Alright? So let's look at the accounting equation. Assets is equal to capital plus liabilities. Now, do you remember what's the investment called? It's called capital. So capital is equal to $60,000. Now, if you remember the previous video, I do encourage you to check it. It will be linked in the description box. We said that the resources of the business are equal to owner's resources, right? As it is given in the equation as well. Hence, in this situation, your assets or business resources will remain equal. We don't have any liability. So what went into business? $60,000. Who gave it? It was capital. So assets is equal to capital. Alright? Both sides are equal. Next transaction is purchase of land. ABC purchased a land of $40,000 for his office. Again, there is your accounting equation. Now assets are divided. Alright, see, we had cash, $60,000. Now we bought land. For how much? For $40,000. So what are we going to do? We are going to look at the assets. We will subtract 40,000 from cash and we will add another entry called land for $40,000. Is there any impact on capital? No, there was no infusion of more money into the business. Capital and liabilities only change when there is extra money coming into the business. When there is revenue even going out of the business, or you are paying for expenses, or there is loan. But in this case, there is no such situation. We just took the cash which was available in our assets and we bought land. So the only thing that changes here is assets. This would be a lot easier to study in a table, which is why I have created one. Let's look at that. You see over here, assets, we have listed all the assets we have. Cash, $20,000. Land, $40,000. What's our total? $60,000. Is there any change in capital or liabilities? No. So everything is balanced so far. Now let's go to the next transaction. Purchase of office supplies. ABC purchases stationery and office supplies on account for $500. On account. What is on account? On account means it's a promise that you will pay later. It's a liability. Okay? So you purchased something on account. Now here is something I want to tell you which will help you in remembering this on account thing. Do you remember when you go to a hotel or something? You always tell them, hey, put it on my bill, on my room bill, right? My room where I am sitting, you are obviously calculating a bill for that. Put it in that bill. You ate something in a restaurant, you told him, hey, put it in the bill, in my room bill. Alright, it will be done. Just like that, over here we have account. You might be a regular customer over there. You have a good know-how of that place and you have an account over there and you are like, put it on my account, put it on my name. Put it like, hey, this ABC person from this place bought office supplies and will be paying us $500. Perfect, right? So that's our purchase of office supplies. So what happened here? What happened was we got extra assets. Alright, so we will write office supplies $500. Now it was on liability. So we are going to write liabilities account payable $500. Payable, when you are going to pay something, okay, as a business, then you say payables. However, when you are going to receive something, let's say someone bought something on account from you, then you will say this is receivable. I am going to receive that. However, in this situation, in transaction 3, we are actually going to pay for it, right? So that's your transaction 3. Now, total has changed. I forgot to highlight it, but it's now 60,500, right? I really hope you guys are getting it. If you are, make sure to give this video a thumbs up. Next is transaction 4, earning of revenue. ABC earned service revenue of $5,500 by providing accounting services to his clients. The amount was paid in cash. Now the person has told you that ABC earned revenue, okay, of how much? $5,500. What he did doesn't matter for accounting, okay? Obviously it has to be legal, but what he did, who cares? And the amount was paid in cash. This is revenue. In assets, you are going to increase your cash. Alright? They paid you. They were like, hey, sure, you gave us these services and here's your payment. They didn't do it on account. Now, revenue has increased. So you are going to write that in your capital. Like, hey, I earned this much amount. Now your owner's equity has increased. So the total amount you have now has increased as well. It's 66,000. Alright? Now as I told you, whatever you earn, lose or even pay expenses for, that goes from capital. Right? It's very simple. As we all know, the profits or losses are tolerated by the owner. So it all goes in capital. Next is transaction 5. Earning of revenue on account. We did one which was in cash. Now we are doing it on account. ABC earned service revenue of $3,000 with a promise to be paid within a month. Now here is one thing, please remember it. Over here it's written within a month. Is it having any importance in these questions? No. No. You have no importance of it. Don't be confused with it. Don't think, oh my god, do I have to write it? Do I have to write that he will pay within a month? No. Over here it's very simple. You are going to write accounts receivable. Accounts receivable $3,000 and revenue $3,000. Revenue will go in capital and accounts receivable are your assets. Alright, so our total changed. It's now $69,000. Oh my god, our business is booming, guys. It's like top notch. Do give this video a thumbs up if you think so. Alright, transaction 6, payment of expenses. During the month, ABC paid $2,000 cash expenses. Office rent $1,000, salaries $600, and total utilities $400. So in this situation, I have written just expenses and subtracted that. However, do not do that. It's a wrong practice. Why? If you will write just expenses and someone, let's say, asks you, what are these expenses? Now you have to look for receipts and think, oh my god, I don't know. Maybe it was utility, maybe it was electricity, maybe it was office rent, I don't know. So that's why you have to write it, okay? But over here I had less space, so I thought let's just write expenses. However, I have not done this like that in my book, in my notebook, in my guidebook. I don't know what that is, but it is linked in the description box. So over there I have done it properly. Anyway, so what did I do? I subtracted our expenses from cash. We paid in cash. It's written cash expenses. Alright, so it became 67,000. As we said that all the expenses will be paid by capital, we are going to subtract that amount from capital as well. So 67,000, 67,000. Oh my god, awesome. I really hope you guys are actually understanding this because I'm trying to be as detailed as possible. Alright, I have a few issues with being more detailed, but I'm trying to improve myself. So do let me know in the comments below if you are getting it, if you are understanding it, or any feedback would be appreciated. Okay, now next one is payment on account. So remember we actually had a transaction in transaction 3 where we bought office supplies on account. So over here we are paying for those office supplies. We are paying our liabilities. So what did ABC do? In transaction 3, ABC bought office supplies on account and now he paid $400 for that transaction. Alright, perfect. How are we paying? We are paying in cash. So we are going to subtract it from cash. So in assets, cash, and then accounts payable $400. Now, oh, I forgot. I almost forgot to tell you. Whenever there is something written in brackets in accounting, it means that you are subtracting it. Alright guys, so yeah, accounts payable, it became 66,600. And then you went for liabilities. We paid our liabilities, right? We paid $400 of our liabilities. So we are going to subtract it from total liabilities as well. So there were $500 and then we subtracted $400. Now over here as well, our total is 66,600. Alright, there is another transaction. Personal transaction. ABC remodeled his house for $5,000 from his personal funds. Now do focus on personal funds, as in his own saving. So is there any impact on business from this transaction? No, the remodeling was done for the house, not for the business, as well as the amount was taken from the personal funds of the owner, not from the business. So there is no impact on business. Did he pay from the business money? No. Hence, no impact on accounting of the firm. There is no transaction for this. We don't have to subtract or add anything because the guy paid for it from his personal funds and it's not on business. He hasn't remodeled business, he remodeled his house. Alright? There will be a lot of times such transactions to just confuse you. Alright? It's for confusing you. It's a test. You have to know where you are going to write something and where you are not. In these transactions, you can totally write that, hey, this is not something which impacts our business. Perfect answer. Next is collection on account. Alright. So in this one, in transaction 5, remember ABC earned revenue on account and now ABC received $1,000 from the client. We had an account receivable transaction in transaction 5. Now in this transaction, we actually received $1,000 from that accounts receivable. Alright, so what are we going to do? We are going to actually change our assets. It's just like when we bought the land and we just changed our assets. The same thing is happening here. We are adding some more cash, $1,000, and we are going to remove $1,000 from our account receivable. Now there are only $2,000 remaining in our accounts receivable. So what did we do here? We added cash, accounts receivable, $1,000. And in the space of accounts receivable, we subtracted $1,000. Get it? Simple, easy, right? There is no change in capital or liabilities. Next transaction, sale of land. Alright, so ABC sells a piece of his land for $22,000. Again, only assets will change. There has been no investment in the business. No one has paid any money from outside in the business. You received money, $22,000, and you gave up a piece of land which costed $22,000. So you are going to subtract that amount for that piece of land. So land minus $22,000. And you are going to add that amount in cash. Alright? Simple, easy. You have to do nothing. You have to just change your assets. Next we have withdrawing of cash. Whenever there is a word used withdraw or drawings, it means that the owner took money out of business for his personal use. Always remember that. Withdraw, you are withdrawing something. First you invested something and then you withdrew it. Alright, so this guy obviously first invested his money in a business and then he took some money out of it. He withdrew them. Alright, so ABC withdrew $2,100 from business for personal use. So what are we going to do in this situation? He has taken cash. So we are going to subtract our assets and capital. He is taking capital, right? So we have subtracted over here and our total has changed. Obviously, when we are reducing both the sides, it will be reduced by $2,000. Sorry, $2,100. Alright. So yeah, that's it for this video. I really hope you guys enjoyed it. I tried to be as detailed as possible. I hope you guys enjoyed it and understood from it Let me know if you have any questions over here in the comments below, or you have my Instagram as well. You can connect with me over there. Do get the guidebook, or I should say exercise booklet. It's very small, it's very cheap, and I'm pretty sure it's going to help you a lot. So do get it, it will be linked in the description box. And that's it for this video. Do subscribe and share, and I will see you guys in my next video. Bye guys.